Alright. Hello everyone. So today we're going to be covering a new company. It's called Blue Owl Capital. And Dom is going to take a look at the first quarter earnings and an overall stock analysis of it.
Thank you.
Alright.
Can you see my screen?
Yes, perfect.
Cool. All right, so the company, like Matt mentioned, is Blue Owl, and they're essentially an asset management company. So as you can kind of see here, they have three main platforms where they get most of their money from. So first one is credit. So obviously just giving people lines of credit, businesses lines of credit, things like that, for upgrades and things. Next thing is GP Strategic Capital, which essentially is them actually investing in companies, getting some stakes in them to give them money that way. And the last one is real assets, meaning things that they buy, land, buildings, things like that. So these are the three primary ways that they make most of their money. Most of this earnings report is essentially comparing their Q1 2024 to Q1 2025, just kind of showing how they've had a lot of growth in all those different areas since last year. So as you can kind of see, just this gives like a nice little chart to kind of give you an idea, where they talk about assets under management, AUM, and then fee-paying assets under management. Essentially just kind of showing how since Q1 2024, most of them have grown. Definitely their biggest one has definitely been the line of credit. As you can see, all of them clearly just show way more for credit. Less so for the real assets, and then the investment part where they take minority stakes. But still, all of them still do see growth, which is great. Just definitely their biggest thing is absolutely credit. They also recently had fundraising to increase a lot of capital they can put toward other things too, and so that's probably going to help as the quarters go on and kind of see how they decide to use that money. So that's more or less kind of what they're about. So I'll let Matt take over and let him go about the financials about it.
Alright, cool. Alright, thank you, Dom. Appreciate it.
Yep.
Alright, so first thing I'm going to share is their free cash flow. And their free cash flow is actually very good. It's excellent. 2021, 276 million, and now it's 935 million. So really good. That's honestly very good. And I'm kind of surprised that the stock hasn't rallied significantly. But here we are. So that's very good. If we look at their 5-year return, because I do like to check this out sometimes, it has performed. Over the past 5 years, it only performed 71%. So not bad, but not great. I don't think it's even beating the S&P, so it's not that wonderful, but you never know. They do have a pretty high dividend yield, dividend yield, 4.89%. That's extremely high for this company, especially a younger company like this. But I suppose they're trying to attract shareholders. If we check Simply Wall Street, doesn't have a projection actually for free cash flow. They only have a projection for earnings and revenue, but we could probably assume what their free cash flow will be. So right now the numbers for earnings are 91 million, and then revenues 2.5 billion. It's projected that revenue will get to 3.8 billion, and earnings will become 1.2 billion. So earnings will really do well, and I think free cash flow will pretty much be steady. Maybe it will double by 2027. That's my probable guess, just based on what I could see here, the trends. If we look at financial health, the financial health here, isn't okay. So the financial health is okay. Again, it's one of those things you have to be a little cautious of. The debt is higher than the cash and equivalents, and it says it here. Owl's net debt to equity ratio is considered high. That's just something to look out for, kind of like Chip 4, what we were just covering, so just keep in mind of that. If we check my DCF on this, my DCF thinks that it's about 5% undervalued. If we use historical growth, that's Wall Street forecast, if we use historical growth, it's 92% undervalued, so I don't think it's that much. I think that's a little bit kind of ridiculous. I think it's more where Wall Street's coming in line with, like 12%, something like that. If we check Tipranks here, I gotta reload the screen and do it fast. Tipranks is 29% upside, 10 buys, 4 holds. So again, not the best, but not the worst either. I would say that they're decent, but if you were to buy it, maybe buy like a few shares. I wouldn't say like this is a company you could go all in on, just be a little bit more cautious. Dom, what do you think?
I definitely agree. It definitely has potential, but it's not like a ton of upside. So, like Matt said, definitely want to keep your expectations in check. Couple shares, not too much. Definitely maybe like a watch list thing, just to kind
Yeah,
of see how it keeps going. Especially with this new round of capital, you never know. Maybe they get some really good stuff they put their money into, and it shoots up.
totally
It's one
agree.
of those things you never know.
Yeah, I agree.
But definitely want to keep it kind of like a look at best, in my opinion.
Yep, I agree. All right, thank you, Dom. Appreciate it.
Yep. Thanks.